Morning, everybody. Sorry I'm late. Um, let's give everyone a couple of minutes so they can join. I'll get up my slides. Okay. I think it is a small group this morning. Okay, before I get started, is there any questions, concerns, comments you would like to make before we go over the review? Okay. Then let's get started. Put up my slides. Okay, so this class is going to be a review of everything, the main points that we went through in the second half of the class. The exam is broken up into 80% of the marks will come from the second part of the class, and 20% will come from the first part of the class. That's school mandatory. Um, so the focus of this review will be on the stuff from the second part of the class. I probably won't be able to get through everything in the allotted time. It's a lot of material. I've only done it once, but it's in the order that we learned it. So the last item would be the payroll, and the payroll we did just last week. So we shouldn't have that many questions or concerns on it because it's fresh in our heads. As always, my advice to you is if you find yourself in the exam, well, it's kind of hard with Pearson not to do this, but if you can't, yeah, it's impossible with Pearson not to do this. You just keep on moving on. You don't know what you don't know. It's more when you're doing a written exam that my advice is if it doesn't work out, just spend a few minutes trying to figure out and leave. But that's really not here in Pearson. So the first part of the class was really focused on the concept of building the story. Something has happened. Do we want to recognize it all the way to the end of the financial statements and resetting our accounts to ensure that we're ready to start the new period and our new storytelling? The second part of the class really looked at how are we going to use this information to make our company bigger, better, faster, and stronger. Um, there's no point in doing anything if you're not going to use the information to change your decision making, if you're not going to use it to learn from it. If you're not doing something to help you learn from it, then all you're doing is playing. I remember when I would be getting ready to study for my finals, and trust me, I get it. My finals always, well, not always, but a good percentage of the time when I was doing my first degree, the finals always brought down my marks, almost always. And I get it. I can now see years and years later what I did exactly to do it wrong. But I know the very first thing I would do whenever I would sit down and start to study for my finals is I would tabulate the marks I had in each class. I would tabulate the marks I would have in each class, and I would start to get you know, uh, um, an understanding of where I was in each and every single class. Okay. And I would then kind of maybe do about, what do I have to get on each final exam to get the mark I want in that particular class. Now, if that's all I did with that information, all I was doing was procrastinating. I wasn't getting down to studying. I wasn't doing anything to change what I was going to do in the future. But then I would do something that would make it more than just playing with math. I would then allocate my time that I had to study based on the exams I needed the best mark in. So if I had my marketing class and I wasn't doing well in my marketing class, because you know why, then I would turn around and say, great, you know what? I need to get a solid mark in this class. So I'm going to allocate 1/3 of my study time to actually getting marketing down pat. But in my accounting class, I know I'm going to get the mark I want just by putting my name on the paper. So I'm going to give it just 10% of my study time. And I would start to allocate it that way, changing what I was going to do in the future based on the results that I saw from my past. And that's what this second part of the class was, is how do we change what we're going to do in the future based on the results that we've seen in the past, right? What did we learn? Patterns. And one of the first patterns we kind of walk through is the kind of concept of what is the profit cycle or operation cycle, what I call the heartbeat of the company, where we have cash, we invest that cash into something. We used inventory as an example, but I talked in all classes. This could have really been anything. It could have been inventory. It could have been raw material. It could have been in intellectual properties, labor. It could have been in tons of different things. We use inventory because everyone kind of knows and understands it. We invest our money into our inventory, and then we go and we sell that particular product. And then when we sell it, we turn it back into cash. If we're thinking about my chocolate bar company, we buy my chocolate bars for 50 cents. I sell them for $1. I take my 50 cents, I invest it into a chocolate bar. And now I go and I sell that chocolate bar. And when I turn that sale back into cash, I now have $1. So I can go and buy 2 chocolate bars. I go and sell the 2 chocolate bars. I now have $2. So I can go buy 4 chocolate bars and so forth. This cycle is, you can see it. This is how Amazon was created, a little tiny specialty online bookstore done in somebody's garage. Within my lifetime, done in somebody's garage and changed into a business mecca, right? Arguably the biggest business in the world that's publicly traded, right? Biggest businesses in the world are probably some of those oil industry, state-owned oil industries in the Middle East, but whatever. This became a way of really understanding the patterns because at each step of these things, there's risk. There's risk here, there's risk here, there's risk here. And understanding this risk, and the risk is necessary. The risk is why we are able to sell our product for more than what it cost us, right? No risk, everyone would do it, right? No risk, everyone would do it. We wouldn't have a business, right? Risk, now people don't want to necessarily do it. They don't want to take on the risk. They don't want to take on the use of scarce resources to do it. So they'd rather pay for it, right? I don't want to pre-think that my chocolate bar purchases. I don't want to take on the risk of theft and spoilage and damage and everything else. I don't want to carry inventory, right? I don't, I don't want to worry about having the right thing at the right time. I don't want to worry about cash flow, right? Having the money before I really want the chocolate. I don't want to worry about all these things. So I'm willing to spend $1 on a chocolate bar that I know is only 50 cents, right? I'm willing to do that, not take on any of these risks. So we start to look at each one of these, and this is what we really spent the class, the last, from week 9 on, focused on. Okay. How do we use this information to understand the risk and make a decision on if we're improving the business or hurting the business, on how we manage this risk and how we can change to do something better? Because remember, the business only does what we tell it to do, right? The business only does what we tell it to do. There is no living, breathing, to the business with a thought of its own, right? It just does what we tell it to do. Once we get this type of understanding, we're going to start to look at vertical and horizontal analysis. One of the big vertical analysis was the concept of gross margin and profit. And what does gross margin and profit really looks at? It looks at that, my chocolate bar company, and we have number of units sold. We have revenue. We know we sell our product for $1, and we have our cost of goods sold. And in this case, it's only 50 cents, gives us our gross profit, which allows us to have a gross margin. The gross profit is dollar, the margin is percentage. People use them interchangeably now. There's no way around it, right? People use them interchangeably. I sometimes am talking about gross margin dollar amount and then have to say gross margin again when I want to get to the percentage. Like it's just used so interchangeably. And then we have our operational costs, what we call as OPEX, and that is things like my rent, right? And that's always $1,000. And we start to get an understanding of these costs, their behaviors, their items are different. Before it was just revenue minus expenses equals profit. And this is true. It's the same thing. This is an expense. This is an expense. They're not anything different, but we break it out based on the ones that are variable and the ones that are fixed, right? Because they have different behaviors. And how do these different behaviors change the way we see our business and the expectations of what it's going to do? We sell just one unit. One times one is one. One times 50 cents is 50 cents. That gives us a 50% gross margin. More importantly, it gives us a 50% gross margin. How do we get gross margin? It's that gross profit divided by revenue, the vertical analysis. Right? And then we have the rent. The rent's always the same, $1,000. We sell one unit, $1,000. We sell 1,000 units, $1,000. We sell 4,000 units for $1,000. That's the constant. The other constant is no matter what, we're going to hold gross margin of 50%. Unless we change something in our business, unless we tell our business to do something different, these are going to be the constant that allows us to predict the business. Yield and yield. Okay. Then I can start to do things really wicked fast once I know this. Right? This would give me a loss of 99950. Right? I know right off the bat that this is going to give me a loss of $500. I don't even need to do any more work. And I know that this is going to give me a profit of $1,000 because I start to understand my business. This is constant. It's always there. When I think about the 50%, I sell my products for $1 each. 1,000 times 1 is 1,000. 1,000 times 50 cents is 500. 1,000 minus 50 is 500. 500 minus 1,000 is 500. Negative. Same thing. I know I'm going to get to keep 50% of my revenue, $2,000, right? 4 times 1, 4,000. 4 times 50% is 2,000. 4,000 minus 2,000, 2,000, 2,000 minus 1,000 is $1,000. I'm able to predict my business because I know the behaviors of my constants. Okay? And that becomes very, very key. I can play all day long. Now, we did all different types of scenarios with this. We had a lot of fun with this, actually. I think we opened different locations. We have a kiosk right at the front, and it costs us $8,000, but it increases our sales by 4 or 5 times. Is that a smart thing to do? And we said, no, that it's not a smart thing to do. Let's go and open up a whole bunch of more stores around the school. So one on every single floor. Is that a smart thing to do? Or do we just do nothing? Is that a smart thing to do? And we're able to predict the business without taking on any sort of risk because we know how the business is going to behave under different scenarios. All right. Oops. Sorry, spelling mistake. All right. The gross margin percentage is 60%. Why? Because it's the gross profit, 59,999 divided by 999,999. The revenue minus the gross profit. And what we didn't talk about here is the profit percentage. And the profit percentage is, once again, it's the profit because it's the vertical analysis by the revenue. In this case, 249,999 over 999,999. And that's 25%. right? What does this mean? It means for every single dollar of revenue we get to keep 60 cents in our pockets to cover our fixed expenses and have for profit. What does this one mean? It means at this level of sales, and this is key, at this level of sales, we have for every single dollar that we sell, we get to keep 25 cents for profit. Excuse me. Why do I right here say this level of sales? Anyone understand why here I say it's always going to be 60 cents, but down here I suddenly change my wording just a little bit and say at this level of sales, we get to keep 25%. Anyone know why I suddenly changed my wording a little bit? Shout it out. Let me know there's people actually out there.
Excuse me, sir. Good morning.
Good morning.
I got distracted for a second. So, what was the question? I've
No worries. I get it. It's hard to stay focused when you're online. When I look at my gross margin, I say for every single dollar that I sell, I get to keep 60 cents in my pocket to cover my fixed expenses and my profit.
yeah,
When I talk about my profit percentage, I say at this level of sales, I get to keep 25% of my revenue for profit. Why do I suddenly make this one seem that's more variable than the gross margin?
it's only and solely because of the fixed cost that is an operational expense, isn't?
Exactly. So as my revenue increases, this will always be 60%. I'll show you an example. You're bang on, by the way. As my revenue increases, 60% will hold. We'll push the example way out there. We will do, that's a million. So we're going to do um, up or down. So we'll do 500,000 and 2 million. Right? My 60% will always hold. It's a constant, right? So in this case, it would be $300,000. And in this case, it would be $1.2 million. Okay. How do I know that? Because 60% of 500 is 300 and 60% of 2 million is $1.2 million. Okay. I know that right off the bat. This $350,000 is a constant, right? So we can see that I'm going to get a greater level. Here I have a loss of $50,000, making this thing a negative 10%. See how it shrunk? Notice why we use brackets, because that looks like a negative sign. That's why we use brackets, right? We shouldn't use negative signs. And over here, it is, I can't do it in my head. I wish it was $300,000. I could do it. 3500 divided by 1200. It is 29%. Oops, no, that's not right. Sorry, my mistake. 850. To mean that percentage is 850 divided by 2 million is 42.5%. Okay? You see how it grows with the increase because this $300,000, which is constant, is getting spread out over more gross profit. In fact, the best my business can do is at the highest level is 60%, right? Because we get close, this $300,000 becomes less and less relative as my gross profit becomes larger and larger and larger, right? We can see that if I push this thing up to $100 million worth of sales, $100 million worth of sales would give me $60 million worth of gross profit. That $350,000 looks meaningless. And it'll get very, very close. It'll be like 58, 59% profit. And I grow it up to $1 billion worth of revenue. $1 billion worth of revenue will give me $600 million worth of gross profit. How do I know that? $1 billion times by 60% is 600 million. And then this $350,000 looks meaningless. And this will be almost exactly 60%. Okay. We can get closer and closer and closer and closer and closer to this number. That's another predictor of the business that I can use. Okay. Any questions on the operation cycle vertical analysis? This is now a horizontal analysis where we start to do it this way. Okay. This was my vertical analysis when we start to do it this way. Any questions on the operating cycle, gross margin, gross profit, and the vertical analysis, or using it for horizontal analysis?
Thank you. Nothing's from here.
Perfecto. One of the challenges then becomes when we start to turn around and we say, hey, let's look at our, you take that revenue minus expenses, and we say we want to start to focus on those variable expenses. We need to watch, in this case, the inventory, how the inventory goes from cash into inventory into our cost of goods sold, right? It becomes key to understand that, right? Cash into inventory into blah, 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 blah. Cash into inventory, inventory into cost of goods sold, cash or bank account, inventory, cost of goods sold. We take our cash, we credit the cash, debit the inventory to grow the inventory as you purchase. I take my 50 cents, give it to my supplier, and increase my inventory 50 cents. And then when I sell the product, I got to take the value of that inventory and put it into cost of goods sold. And here we have the separation between the balance sheet and the income statement, right? My aha moment in accounting, my kind of moment where I was like, oh, this stuff is not hard to grasp, is when I saw the connection between the balance sheet and the income statement. I remember it. I remember it clearly. And then, except for remembering nuances of particular types of rules, accounting was never complicated for me. The concept of debits and credits was it just stuck in my head once I understood this. It'll be different for everybody else. If you're like, I see this, but it doesn't change anything for me, don't worry. Understanding this flow, we need to make sure that this information is perfect, or as close to perfect as we can get. Because as close as we get to perfect, as close as you get to using perfect information, as close as you can get to having really, really good, verifiable, and reliable, repeatable data. And that makes a lot of sense, right? If I teach you the concepts perfectly, I give you all the information that you need, then you have every single thing inside of your resources to make the right decision. But if I give you bad information, you might use the information correctly, but it's wrong. You're going to make a wrong decision. That makes a lot of sense, right? If I turn around and I teach you how to do something wrong, right? And you go and you do it, and you find out that you don't get the answer you thought you were going to get. Well, that's because it was junk in, junk out. It didn't matter what you did because it was bad information. Same thing here, right? The bad information results in bad decision making because you are not properly tracking what's occurring inside of your business. Right? Remember, these aren't actual numbers. These are my different scenarios. And I predict what's going to happen based on my knowledge of the business, what I think I told it to do. So what do we need to do? We need to make sure that we're properly tracking this flow to ensure that the values that we're putting in here are correct. So when we mimic them inside of our models, they are correct as well. Okay. So the first thing we started really focusing on was inventory valuation. Now, to get inventory valuation, you need to have two components, right? You need to have the dollar amount, the cost, and the number of units, right? If I ask you, what's the value of our inventory? And you say to me, we have 35 units, you haven't answered my question. I asked you what the value of my inventory is. 35 units doesn't mean anything. 35 units of my chocolate bar company has one value, and 35 units of a company that sells spaceships has a different value, right? 35 is meaningless. if I turn around to you and I say, what's the value of our inventory? And you say, each unit costs 50 cents. Okay, do I have 1 unit or 100 million units, right? You need to have that combination between your inventory, what is the cost multiplied by the number of units will give you your total value of your inventory. For the cost, we said we're going to simply use FIFO. What is FIFO? FIFO is that simple concept of first in, first out. What does that mean? Well, I always do that. What does that mean? Well, we use the pipeline as our example. And as our inventory comes in, we place it into our pipeline, right? The very first one came in was 50 cents. Excuse me. The very second one was 51 cents. The next one was 49. The next one was 48. The next one was 52. The next one was 50 cents again, right? As they come into the order, this one first, second, third, fourth, fifth, sixth. When we go and we put them over to our cost of goods sold, they have to go out in the order that they came in. First in, first out. Second in, second out. Okay? As we put them into our inventory is how they have to be released into our cost of goods sold. Okay? That's the concept of FIFO. Great. We have that. The second part is we said that there's going to be the number of units, and that's going to be periodic or perpetual. There are other ones, just like there's other ways of doing costing. There's weighted average, there's specific, and so forth. There's other ones other than periodic and perpetual, but these are the combinations that we're going to use. You're either going to evaluate your inventory by periodic FIFO or perpetual FIFO. Periodic is a simple way of looking at our inventory, not simple as in lazy, not simple as in not good, simple as in it doesn't go into the details because we have no value inside the details, right? There's this cost benefit pull always when we're looking at information, right? And I don't need to have more information than this that I have in what I'm going to show you how to do inside of periodic, because it's, I use the example of lettuce. I know there's no need for me to track, on Wednesday how many heads of lettuce I have, right? I just don't want to run out, right? I don't need to track how many loaves of bread I have at any exact moment. I just can't run out, right? So when we're kind of focused on that, we simply just say to ourselves, look, we're talking just about the number of units. We have to know what we started with. And we always do know what we started with. Why? Because our closing balance becomes our opening balance, right? When a period ends and I know I have 20 units on hand, let's say I'm in my store, I look at my store, I see I have 20 units sitting on my shelves. I verify them, I count them, I leave. The next day, unless something funky is going on, there should be 20 units there. The closing balance becomes the opening balance. Unless I do something to change it, I will always have 20 units there. Just like my bank account, right? I have $500 in my bank account. Is 1 second to midnight, December 31st, 1999. The very next second, it's a new day, a new month, a new year, a new decade, a new century. The concept of time in the Gregorian calendar has exploded, right? But if I look at my bank account, there's still just $500 in there. The closing balance became the opening balance, even though the concept of time has gone over there. And if I leave that $500 in that bank account and I don't do anything to that bank account, it will be $500 forever, because a dollar is a dollar is a dollar. The purchasing power changes. We've seen that recently, right? If you had $1,000 that you had 2 years ago doesn't buy what it buys today, the purchasing power has diminished substantially. Okay, that's no problem. That's an economic reality, but it's still $1,000, right? So the number of units don't change. So we know, because we have to do a closing, We have 20. And then we know what we purchased. At a bare minimum, we know what we purchased because we know what we paid to our suppliers. That allows me to have everything that's available inside of my system for sale. Okay. Not at one point in time, right? I didn't have at one point in time 220 units. I'm just saying, look, I started the day with 20. Throughout the day, another 200 were delivered randomly. So in essence, I had 220 units that I could sell. You then go and you do the same thing. You do your inventory count. Every single business has to verify its inventory at least once per year. Okay, tied into the financial statements and your taxes to the Canadian government. The Canadian government has made it mandatory that every single business verifies its inventory at least once per year. Okay, this verification of your inventory allows us to understand of every single thing that we had. Terrible circle, but you guys get it. Number of units available equals 220. I find that I have 30 units left on hand. 30 units are still in inventory. That means 190 units in one way, shape, or form has gone to cost of goods sold, has left my company. Okay? Because it's only in inventory or cost of goods sold. All right. Now, why do I say it's so weird? Why don't I just say 190 units when's cost of goods sold? Why do I say cost of goods sold in one way, shape, or form? Why do I sound so weird all the time?
Because it also includes the inventory that may have been lost or stolen.
Correct. You're on fire today. It's I don't know. All I know is I had this many and I have this left over. So I'm gonna hope that there's revenue attached to them, but there could have been theft, there could have been human error, there could have been spoilage, there could have been damage. Like think about lettuce once again. Restaurants that have salads have lettuce. You can get the concept that lettuce disappears, right? It spoils. Maybe they go to grab it and it falls on the floor, it gets lost. When you think about the concept of a full head of lettuce, maybe they cut up the salad, but 25% of that lettuce just gets tossed in the garbage because it's the butt end of the head of lettuce, whatever it could be, right? Maybe as the person's making their salad, they're eating some of the lettuce as they go along, right? I know a lot of people that work in kitchens and they eat the food that they make, right? So there's tons of different things that could happen. Some of them normal courses of business, some of them not, like theft, but they may be acceptable. Either way, they all go to cost of goods sold because we have no other way of tracking it. We know what we had, we know what we have less. That's everything else that's left the business. We know what we have, we know what we had left. This is every single thing that's left the business. We just accept it as cost of goods sold. You'll see it in your gross margins. You'll see the effect of theft in your growth margins because your expectations is 50 cents. But the higher my cost of goods sold is without the revenue, this will break, allowing us to understand if we have an issue going on with damage, theft, spoilage, or anything else like that. You're able to see it. But where was I? What slide was I on? Okay. But at this stage, all we know is that it's 190 to cost of goods sold and 30 to inventory. 190 plus 30 equals 220. And the next period, we know something else too. The very next month, the 30 becomes my opening balance. And then I go through the cycle again. Okay. And that is periodic inventory. Okay. How do we allocate then the FIFO component to it? We have to go and understand boogers. I don't want that. Fashion way. How do we add the FIFO component to it? Well, once again, we have the total value. We have that kind of concept that this is, and we'll make it just simple numbers for me, right? This is right. We turn around. We had these units valued at $100. How do we know that? It was the closing balance became the opening balance. We go purchase $200 more. I can see how much I purchased them for. That 220 units, its total cost to me, its total value was $4,100. Great. Now, how do I allocate it between cost of goods sold and closing inventory? Once again, I put the concept of the pipeline in there, right? And from this concept of the pipeline, I can turn around and say, look, 190 of these units, 190 of them went into my cost of goods sold. Ran out of room. So it makes it hard to write. But I can do better than that. Oh, Jesus, sorry. Maybe I cannot do better. There we go. And it's going into my cost of goods sold, right? Also, if this is 190, I can also see what the last 30 are, right? First in, first out, I know it goes this way, but also I know the very last ones in are the ones that are still sitting in inventory. And sometimes I say to myself, look, it's easier to count up 30 balls than it is to count up 190, because once again, once I know the value of one, I know the value of two, because the total value is $4,100. If I turn around and say, look, that value, that 30 units in inventory is I don't know, let's just say $600 for fun, right? And I know that this has to be 3500. Why? Because I know that something plus 600 has to equal 4100, right? So it has to be 100 times out of 100, $3,500. Okay, and that's how FIFO works as well. I just turn around and add up either the last ones that came in or the first 190 ones to come in. And sometimes it's easier just to do the smaller number, but you could do the either way. You're going to get the same result, and that's how FIFO works in here as well. There is an example. I have example, but there's another example there. The next way of doing it is that perpetual inventory. Okay, this is inventory that just you keep on going. You know how much inventory you have on Wednesday, you know how much inventory you have on Thursday. Because you look at that opening balance, and every single time you purchase inventory, your inventory increases. And every single time you sell inventory, your inventory decreases. It keeps a running total of your inventory. If we want to look at an example of that, here we have a nice inventory movement. We start off with 100 units, and 60 of them are at $10, and 40 of them are at $9. Whatever you see in this order, it tells you your pipeline. The first 60 in are $10. The next 40 are $9. I could have 60 individual pieces of inventory, all valuated at individual amounts. This is just how I do my purchasing and how the pricing works. So I want to track it. I got to get a little bit more detail. I got to have the concept of here's my purchases, units, cost, total value. Here's my cost of goods sold. And remember, this is inventory into cost of goods sold, not inventory into revenue. Inventory into cost of goods sold, units, dollar amounts, total value, and my inventory balance. So when I opened my inventory, the opening for the month, I had 60 units and 40 units. The 60 units was at $10 and the 40 units was at $9. Okay. The very next thing that occurred, and you can fill out the rest of this, you can fill it out into the details that you need it. Okay. I always say there's 0 marks for this. This is just how you're going to organize your information. There's 0 marks on how you organize the information. And if you like to organize it differently than me, go for it. If your answer is the same as my answer, absolutely no problem. Okay? However it works. I'll figure it out. Do not turn around. Oh, this is all in. I keep on forgetting this is all in my accounting lab. So they tell you how you're going to do this. And I'm pretty sure this is the exact same way that my accounting lab shows you, but it's conceptually the same thing. Right? They'll tell you the format and the boxes you need to fill out. Make sure you fill out all the boxes that they ask you to. The very next thing that occurs is we do a purchase of 100 units at $11. So what we're doing is remember, as we purchase, our inventory goes up, and as we sell, our inventory goes down. So we do a purchase. This will typically have a date associated with it, but the main thing is that we're going to grow our pipeline. Okay, so now I see in my pipeline I have 200 balls. The first 60 are at $10, the next 40 are at $9, and the next 100 is $11. This line just helps you guys visually see the difference between step 1, step 2, and step 3. It has no other meaning than that. The next thing that happens is I go and I sell 150 units at $25 each. Now, this is a mistake that a lot of students make. When I say I'm going to sell 150 units at $25 each, that's a revenue statement, right? That's a revenue statement. I sold 150 units for $25 each. I don't care about the $25 each. That's not my cost of goods sold. That's my revenue. What I care about is 150 units. That 150 units is now what's going to leave my inventory and my cost of goods sold. So I go over to my cost of goods sold and I see I got to pull out 150 units. The first thing I look at is I see the next 60 balls are all going to come out at $10 each. And I note to myself that 150 units is greater than 60. So I take all of these units. Okay. And then I said to myself, perfect. 150 minus 60, I need 90 more units. I look at the next set, and the next 40 units are coming out at $9 each. I'm like, okay, great. 90 is larger than 40. I'm going to grab all of these suckers. All right. And should be able to do this in my head, but I don't trust myself. This morning, 360. Right. Now I need 50 units because 150 minus 60 minus 40 is 50 units. And I say to myself, great, 50 units is less than the next 100 balls. So I know I'm only going to take a portion of these. And 100 minus 50 leaves me with 50 units left. I take the 50 over here at $11. That's 550. I know that these 150 units that I sold have a cost of goods sold value of 600 plus 360 plus 550, which is $1,510. I also know now that inside of my inventory is just 50 units at $11 for $550. Okay. That step is done. I keep on moving. All right, I've completed this, I've completed this, I've completed this. I see I go and do another purchase of another 100 units for $8 each. So I have a purchase, right? I should have put down here my 100 units at $11, right? And I have another 100 units at $8, increasing my inventory by keep my pipeline. And I keep my pipeline readily available so I can grab it when I need it. 150 units. And next thing that happens is I sell 99 units for $25 each. Once again, that's a revenue statement. I don't need to know the revenue. I need to know how many units are going to be transferred out of my inventory into my cost of goods sold because the customer is leaving with my asset. They leave with my asset. I lose its future value, meaning I have to reduce its future value. The inventory is decreased and the cost of goods sold is increased. I sell 99 units. I look at my pipeline. I see the next 50 are $11. 99 is larger than 50, so I grab all of them, making that 0. Right? I blanked out for a second. 50 units at $11, 550. right? I now need to sell 99 units. So I have 49 units that I need to put into cost of goods sold. I see the next 100 balls are all at $8 each. 100 is bigger than 49, so I take them all from there, leaving me with 51 units at $8 each. And 49 goes over here at $8. 49 times by 8 is 392. That means that this total sale of 99 units, oops, has a cost of goods sold value of 942. Okay, and what's left in my inventory is 51 units at $8 each for 408. All right, now I know based on this alone, I know I have a couple of important pieces of information. First of all, my cost of my closing value of my inventory is $408, right? It's that final amount because inventory is a balance sheet item, and a balance sheet item is a snapshot, a moment in time. And this moment of time is the end of the period, and there's $408 sitting inside of inventory. My cost of goods sold is a sum of everything that has happened over the time of the movie that I'm showing. This movie's, I don't know, let's say of April 2024, and over the month of April 2024 I had two sales, and the total value of those two sales becomes my cost of goods sold, and that's 1510 plus 942, which is 2452. Okay, it's the sum. Balance sheet item becomes just the end amount. This is the sum, and it's this plus this, obviously. Okay. Now, just like in my perpetual inventory is based on the concept of that inventory count, the validation of my inventory, on my periodic, sorry. My periodic inventory is based on the valuation of the inventory count. Just because I'm doing perpetual inventory doesn't mean I don't have to verify my inventory. I must verify my inventory. How do I verify inventory? I go out there and I physically count it. Excuse me. I go out there and I physically count my inventory. By physically counting my inventory, I can have validation of how much inventory I have on hand. I go and I physically count the inventory and I see that there's 50 units. I physically count 50 units. I look at my inventory and I see I only have 51. Right? Count says 50. My sheet says 51. The count says 50. My beautiful, beautiful, beautiful perpetual inventory says 51. What's my reality? Anyone know what the true reality of the situation is? 50 or 51? What is the true reality of my inventory?
The true reality would be what's left in the inventory. So it would be the inventory balance. It would, like, the price doesn't matter because you might have lost something in the middle.
So is it 50 or 51?
It's 50.
Right, right. What I physically go and touch is provable. This 51, it could be anything, right? Not only could I have a mistake on here, human error, I could also have theft that's not represented in here. Remember, inventory goes up with purchases, down with cost of goods sold. There's no concept of theft. There's no concept of human error. There's no concept of spoilage. There's no concept of damage. There's no concept of misplaced. There's none of these concepts in here. It's just, what did I buy? What did I start with? What did I buy? What did I sell? So the inventory count grounds this back into reality. But now I have to deal with the fact that I have 50 units, not 49. How do I go and correct this? Well, it's not in my story. It's not my story, so I have to go and add it to my story. How do I go and add it to my story? You write a journal entry. Say you add the sentence to the actual story. And how do I add the sentence? Well, I'm going to reduce my inventory by 1 unit. I remember my aller never goes away. Your aller and your debits equal your credits. Whenever you say to yourself, I'm going to write a sentence, I have to remember that I've got to use at least 2 accounts. And my debits have to equal my credits. And an inventory item is an asset. It increases with a debit, but I'm going to be reducing it from 51 units to 50 CR inventory. Great. And I know it's 1 unit, but I can't write down 1 unit. I have to write down a dollar amount. Well, I don't know when this item disappeared. All I say to myself is, great, I'm going to take the very next one in the pipeline. This seems simple because there's only one, but I would take the very next one in the pipeline. If I happened up here, I would take the $11 because that would be the very next item in my inventory. If it happened up here, I would take the $10 because that's the very next item in my pipeline. Okay, so I would go and just simply say 1 at $8, which equals $8. $8. What do I do it to? You can put it to several things. Just say cost of goods sold, right? If they turn around, they give you an account called inventory variation, just put a cost of goods, right? Know that it's going to go on your income statement as an expense. All right. If by any chance my inventory would have increased, in this case it decreased, so I decreased my inventory. If it would have increased, I would have to debit my inventory. All right. And I know that it's 1 unit. Let's say it increased by 1 unit. I would then pretend that the ball was coming back into the tube, back into the pipeline. So I would look at the very last one it sold at, which would be $8 here. If I happen to find it here, it would be $11. It would come back into my inventory at the last price it was sold at, just like the ball got sucked back in to the pipeline. Rather than going to cost of goods sold, it got put back in inventory. You just take the last price. You don't know when this occurred, so you just take the last price. Okay. In this case, 8. So it would be $8. And once again, also cost of goods sold. Okay. Any questions on inventory valuation, FIFO, periodic, or perpetual? No questions? Let's keep on rolling. Bank reconciliation. This will be chapter 8. Okay. Bank reconciliations. What's happening inside of bank reconciliation is the concept of our bank account, RBC, BMO, TD, right? They track our cash, what money we have inside of our business bank account based on cash flow. This is what we start with. Cash comes in, our balance goes up. Cash comes out, our balance goes down. All right. Our financial records, our books, capture our cash movement based on accrual accounting. That means when we write the check, it automatically comes out of our bank account, not when it gets cashed. When we write the check, it automatically comes out of our bank account, accrual accounting, and the bank doesn't care. The check was not cash, it has not come out, it's cash accounting. Okay? Now, just because there's the difference in how the accounting's done, we still have to use our bank statement to verify our books. Just like we have to verify our inventory, we also have to verify our bank account, and this is known as a bank reconciliation. How do we start to do that? Well, we're simply going to compare the two. And what we're going to do is we're going to see if there's any differences between what's happened in our books and what's happened in our bank account. And if there is any differences, we're going to investigate them to see if they make sense based on the fact that we're accrual accounting and cash accounting, or if something funky is going on. To do your bank reconciliation, you're typically given 3 to 4 pieces of information. You're always given what's happening in your books. Sometimes I give it to you in a T account, and you can see the debits and credits. Sometimes I say cash receipts, which is the cash coming in, so you know it's a debit, and cash payments, it's a credit. Because why? It's an asset. Cash is an asset. So your debits increase it, your credit decreases it. You're always given the bank statement. This is your legal document, your validation of proof that you have $29, almost $30,000 in your bank account at the end of November 2020. right? A third piece of information you would get is some sort of additional information. All right. This additional information will help you understand some of the details that you have inside of your bank reconciliation. The final piece of information that you would have is a concept of, is there any historical information? You don't always get this. Sometimes you go and you look at your bank to your books, and the very first step is we want to validate that the opening balances are the same. Here we have an opening balance of 18,223, and I look at the balance of my October bank account, and I see that the balance of my October bank account is 19,323. The opening balances do not match, right? This November the 1st, well, we know that the closing amount becomes the opening amount. So not only is it November's the first amount, but it's also the last amount for October 31st. The opening amount of 18,223 does not match what my financial records say, 19,323. What has happened? If I look at it, I'm going to say my bank balance as of October 31st is 18,223. And my how do I want to say it? It has a different name here when you do an actual bank reconciliation, but I will just fill it in for October, is 19,323. I've got a $1,100 variance between the two. And I'm given the information of what that is because there's historical. Okay, if they're the exact same, there's nothing historical you have to deal with. You got the exact same amounts. That means that your bank account equals your bank books, and there's no outstanding items. There's no timing items to deal with. But in here there are. There are three timing items. We have an October 31st deposit that's still in transit, meaning it's in my books, my ledgers. I recognized an October $2,000 deposit. My bank account hasn't seen the cash yet. Why? Because maybe I deposited at 10 o'clock at night when the bank's closed. Maybe I deposited on a Sunday when the bank isn't recording its information. Who knows why? It's just when I looked at my November bank statement, it wasn't there. And when I looked at my November bank ledger, my balance sheet, it was there. So it's just a timing issue. So I have an in transit. It's on its way. That's what in transit means. $2,000. It would increase it. And what makes it less? I have outstanding checks. Once again, I'll spell it out. It always confuses people when I use my shorthand. All right, and I have checks. This number coding's off. I don't know why. Right? Let me just fix that right here. The code's off. Well, who cares? Who cares if the code's off? Well, yeah, I do because it's impossible. Just a simple little typo. This should be 1218. This should be 1219. Excuse the simple little mistake. I have two checks, 1218, 1219. 1218s for $400, 1219s for $500, which means I have $900 of outstanding checks, and my adjusted bank balance as of October 31st, 18,223 plus 2,000 minus 900 equals 19,323. That's what this means, right? If I look at my October bank reconciliation, the difference between my opening and my closing balance is three timing issues: a deposit, two checks outstanding. Great. Sometimes you have that, sometimes you don't. Sometimes they balance. If you see that they balance, that the opening and the opening balances for both your banks and your books is the exact same, no problem. You don't have an issue. You don't need any historical information. Here we have an issue, historical information. Let's use it to move forward. Now, once we know that, we can start to do what I call isolate or eliminate. Okay, isolate or eliminate. This allows us to find the needle in the haystack. Something's making these numbers wrong. And I'll tell you this right now, and listen very clearly. On the exam, they 100% reconcile. Okay, we're not going to have you go and do this step, and your final step is to declare that there's some sort of fraud or theft going on in your company. Your bank reconciliation will reconcile if you did it properly, period. Okay, there is not another option. So you should be moving towards it being reconciled and just demonstrating, the steps you have to do to be able to find what's causing the variance between your bank account RBC and your books, what's on your balance sheet. Okay, I'm able to do that by a process that I call isolate and eliminate. How do you do that? We start to look at the information that's here. And we start to say, look, the variance is caused by items that are in here and not in here, or vice versa, items that I have in here that are not in here. That's what's causing the variance. If it's in both lists, it's not a part of the variance. It's not a part of your problem. So I want to start to go through each item and verify if it's on both lists. It's on both lists, eliminate. Don't look at it again. It's not a part of your problem. I use the example of when I look for my glasses. My glasses, 99% of the time, are in one of two places. They're either upstairs on a little cute little owl that I have that my kids gave me that I can put my glasses on. It either sits on there or it sits on my desk. And it just depends where I took my glasses off. When I came home, I put it up there. And when I come down and work in my office, sometimes I just take them off and leave them on my desk. It's in one of those two places, 99, 95% of the time. Every once in a while, though, I take it off in a different location and forget where I put them. So when I go and I search for my glasses, the very first place I check is that owl. And it's not there. So I go, no problem. I go down, I look on my desk. It's not there. Well, now I know that I've taken it off somewhere and I'm trying to remember where I put it. So I start searching in other places of the house for my glasses. Maybe I check coat pockets, I do this. Eventually what happens is I go back to the owl to make sure that they're really not there. And I look around the owl and all this other stuff. And then I get frustrated. I go back to it. It's probably on my desk. I didn't see it. Go down there, look on my desk. It's not there. I start to repeat my steps over and over again because I'm trying to find something where I have no clue where it is. And I'm just trying to do something rather than just sit around pouting because I don't have my glasses. All right. But by going back to the owl and going back to my desk, I'm just wasting time. Right. So what I'd want to do is eliminate the owl, eliminate my desk. I can't do that. But here in a bank reconciliation, I can. How do I do that? I start, and I always use the bank information first and then use that to go into my books. Why? My books is controlled. Look at this, check numbers in order, deposits in order. Here, not necessarily so, right? The check numbers are in order just because of the question, right? But here's one, 1219 is before all of these other ones or after all of these other ones, right? The individual, they cash the check. They control it. I don't control when they cash the check. I just control when I gave it to them. Okay? So controlled, uncontrolled, it's easier to find things taking the uncontrolled and putting in the controlled and vice versa. If I'm looking for check 1225, I have to go through my whole list, touching every single thing. And then what happens is I might miss it and not see it. Well, I don't trust myself. So I go over it again, every single item being touched. And then I see it. I'm like, great, there it is, 1225, 1225, I'm good, right? And then I go for 1226. What do? I start touching every single item again. What a waste. But from here, if I say, let's find 1225, I know exactly where it is. It's between 1224 and 1226. There's 1225. When I'm looking for 1226, it's between 1225 and 1227. It's controlled. It makes sense to me. Okay, there's a pattern. There's no pattern. All right, so I always go from this list to that list. First thing I do is I see that. I see I have a deposit. Well, the opening balances I've already made the comment on. I know what the difference is. I'm comfortable. I see a deposit for $2,000. I go over to all my cash receipts. That's a deposit. These are the debits increasing my bank account. I see that the very first one is 3436. That's not 2000. I note that there is no 2000 even on this list, right? Obviously, it's a part of my variance, it's a part of the difference because I know that my closing balance is 26,983 on my books, and my bank statement says 29,914. There's a $3,000 difference between what my book says and what my bank account says. This is obviously part of the problem, right? Because it's on one list and not the other list. But then I remember that I had an historical item, and it was a $2,000 deposit that I thought happened on October the 31st, but was not in my bank statement. This item is a historical item. It's that $2,000 that I was waiting for. And I eliminate. Okay? I scratch it right off. Never to look at it again. It's no longer a part of my problem, right? In fact, if I look at this, I would say my difference between my bank balance on my books and my bank balance from RBC should only be $900 now. And if I go over here and look at that balance, 20,223 less 19,323 is $900 worth of checks, right? I take the 20,223 minus 900, it'll give me 19,323. That's all that's left in the difference between my opening balances. Great. Keep on moving. Next thing is a rent collected, electronic transfer rent collected, 880. I look on all of my deposits. I don't see an 880 on my list at all. I have no historical information on an 808. I don't know what this is. All I know is it's on one list and not on the other. And I just isolate it. Okay, I just isolate it and move on. It could correct itself down here, right? I want to isolate and move on. I have a deposit for 3436 on November the 6th. I see on November the 5th, I did a deposit for 3436. Whilst the dates aren't the same, they're close enough. There could be a little bit of a timing issue. Don't forget, it's accrual accounting to cash accounting. The only difference between them is timing. I write the check, it automatically comes out of my bank account ledger. The check gets cashed whenever, right? It's only just a timing difference. Here I look at this, I see that around the same day, and I typically give around 3 to 4 days. It could be a long weekend that's causing this difference, a holiday, whatever. I see that they're close enough in date and they're the exact same amount. And to be truthful, I have very, very individualized deposits. None of these things look similar. So I'm going to say to myself, it's the same thing. And the 3436 is this 3436. So I eliminate on both lists. It's not part of my problem. I see I have an NSF, a non-sufficient fund check for 433. Somebody, I cashed a check. They didn't have the money in their bank account, and it came back and was taken out of my bank account. Okay, I go look at my withdrawals or my payments, and I see I have nothing on here for an NSF check. They're all actually just checks that I issued, and there's nothing here for 4333. And once again, the only thing I have on here is 2 outstanding checks. So it's not a part of my historical information. This is causing my variance. I don't know what it is yet, but I isolate it. Okay. Next thing I have is I just move on. Just move on. Don't get stuck on it. Isolate or eliminate, and then deal with it later when you've done everything. I move on. I see the next thing that came out was check 1221. I go to check 1221. It's for 1819. It's 1819. It did exactly what it's supposed to do. I eliminate, never to look at it again. I see I have a deposit on November the 10th for $470. I have a deposit on November the 7th for $470. This could have been Friday of a long weekend. I recorded it inside of my ledgers, but the bank didn't see it until the Monday morning or whatever the next business day was. Either way, it seems to be the exact same thing. So it's on both lists. I eliminate. I have checked 1222 for 1144. Check 1222 for 1144. It's important. Check 1222. Check 1222. I could have 2 checks outstanding for 1144. I can have 2 of them. Okay, but I only have 1 check 1222 for specifically 1144. Only 1 check 1222 specifically for 1144. These are the exact same things. It did exactly what it was supposed to do. I eliminate. Okay, the next thing is 1223. They don't typically go in order. I guess it was just laziness. When I was writing this question, I just made them go in order. But you see, this last one is not in numerical order. Checks come out whenever the person cashes it. I issue 100 checks. I don't know when the individuals are going to cash it. Okay, but it could happen this way. It possibly could. The probability is low. But I have check 1223 for $429. Check 1223 for $429. It did exactly what it was supposed to do. Eliminate. I have a deposit on November the 14th for 1723. I see one day before 1723. It's the same thing. Eliminate. Check 1224 for 111. The only danger starts to become is you start to go so fast through eliminating that sometimes you'll miss little small disconnects. So make sure you're doing whatever you can to ensure that you're not just going, okay, 1224, 1224, XX. You're specifically getting that there's no error in the amounts. Deposit 1065 on the 15th, 1065. It's the same thing. Eliminate. Electronic transfer funds, saying insurance, an amount coming out. It's a withdrawal. I see here I do not have not only the amount, but any sort of electronic transfer. And it's not on my historical information. This is a part of the variance. I want to isolate. Deposit from the 20th for 441. I see that I have the same thing over here. Eliminate. Check 1225 for 816. Check 1225 for 816. Did what it's supposed to do. Eliminate. Deposit for 10875. Deposit for 10875. Did what it was supposed to do. Eliminate. Check number 1226 for 109. 1226, 109. Did exactly what it was supposed to do. Eliminate. Check 1227 for 4968. Check 1227 for 4468. Oops. Something's going on here. 4968. 4468. They're both check 1227, but the amounts are different. Okay, I've got a problem here because the check is on both lists, but the amount is different. Right. And the point is, I'm not going to debate over the fact that the check went through. The concern is that my books believe that 4468 should have came out, and the bank says, no way, Jose, 4968 came out, causing a $500 variance between what my bank account says, because 49 came out, to what my books say, because only 4 came out. $500 difference. Okay, I don't know at this point in time who made the mistake. If I made the mistake, I did not take out $500 enough dollars, so I got to take $500 more out of my books. But if the bank made the mistake, they took out too much money and they owe me $500. So what I'm going to do is, and that's $500 could do with the difference. I don't know. Like I just want to isolate. But I isolate this one a little bit differently. I want to circle it here and let that know that this has a partner. I'll put an A beside it, and I isolate here and also note that this has a partner. Put an A beside it. So I'm going down my list. I can see that these ones are isolated and they're by themselves. This one's isolated, but it has a dance partner, and its dance partner's over here because the difference isn't 4968. The difference is only $500. Perfect. Keep on going. I see the next thing is a bank collection for $1430. No problem. Go over to my collections, which is my receipts. I don't see a $1430. It's on one list, not the other. It's not my historical information, so I want to isolate. I go to check 1219. I go to my checklist. I see my checklist starts at 1221. I don't have a 1219 on November checks that I printed. I go, ha, I remember I have outstanding checks. I see I have a 1219 for $500 bucks. This is for $500. It did exactly what it's supposed to do. I eliminate. It's key not to forget about this because I still have this one item, check 1218 for $400. It's still outstanding, making a difference between the balance of what's in my books and what's in my actual bank account. All right, I then go down, I see a service charge for $25 coming out of my bank account. I look over here and I see I do not have a $25 charge or anything to have to do with. These are all checks. It's on one list, not the other. I isolate. All right, I've now completely gone through this list. There's no item that I have not looked at and either eliminated or isolated. I now go over to this list. Any item that still hasn't been commented on is not on this list. Why? Because I went through this list in totality, so it should have been taken care of. So this I want to isolate. This I want to isolate. This I want to isolate. And this I want to isolate. And I never want to forget this still needs to be isolated. Do not forget your historical items. Great. Now, once I've done that, all I have to do is make a decision because some of these issues are going to be just timing issues. Time will correct it. I'm waiting for the individual to cash their check. Time will correct this. Okay. Or I'm going to have to do something about it. It's a permanent issue. Will always be a difference between the banks and the books unless I write it into my story. So I want to go through each item and say if it's a timing or if it is a permanent issue. I do look to my historical, my additional information to see if there's any details in here. I see an electronic transfer of fund deposit was monthly rent and electronic transfer of fund, I'm going to say payment, better than a debit, was an insurance payment. Okay, great. I understand what these things are. Here's my rent that I collected. It's a deposit. Somebody's paying me rent and they paid me $880. I didn't recognize it. That's okay. I have to recognize it now. It's a permanent issue. It'll always be a difference between the two items unless I deal with it. And same thing here. It's permanent, right? This is legit. I legit paid my insurance company $275. I forgot to record it in my story, but it's a true expense. I was expecting it. Right? I've dealt with this. I go over here and see the non-sufficient fund was received late in October from a customer. So a customer gave me a check. I went and cashed it. It was put into my bank account. My bank talked to the customer's bank account and they said they don't have the money to pay for this. And the bank came back and took the money back. That's what non-sufficient fund means. It means somebody tried to cash a check. I tried to cash somebody's check. They didn't have the money, and the money's taken out of my bank account. All right. Whilst I don't like this situation, it's a permanent situation that unless I correct it, will always be a difference between the two accounts. I was expecting it though, and I'm okay with it. The 1430, don't worry about these details. It's just a bank collection on a notes receivable. Don't worry about the interest. All right. Don't worry about the interest. I make it a little bit harder for other classes. I shouldn't do it for this class, so I'll just leave it. But whatever, the main point is I was expecting it, 1430. Okay, I was expecting it, but I did not record it in my story. It's a permanent issue until I put it inside of my story. And the bank service charge, I'll get to D in a second, but no, I'll do D right now since it's right here. I see that I did get information on check 1227. Notice this is the item that I had the dance partner with, right? I did get the information on 1227, and the information was on 1227 that was a payment on account, and the 4968 was the correct amount. And I had made a mistake. My company made a mistake and recorded 446. The rule here is if the bank makes a mistake, they have to fix it. All right. And I have to wait for them to fix it because they cannot reissue. They cannot. It's against the law for them to reissue my bank statement. Okay, it cannot be reissued. I have to wait, and when the mistake is found, they will correct it, and they will send me. So let's say they notice we noticed the mistake. This is November's statement. They notice the mistake, and they say, okay, great. It's now December the 1st. It will go into December statement. As soon as they figure out the mistake, we put it in there. We cannot backdate it at all because this is a legal document. It's a legal document that can never be changed. All right. The bank makes a mistake, they correct the mistake, and it will be timing. If I make the mistake, I have the mistake. If the company makes a mistake, they have to. And this makes sense. This is like a life lessons, right? If someone else makes a mistake, they have to correct it. And if you make the mistake, you have to correct it. To keep that inside of your mind, here is an issue where I made the mistake. The number is 4968. I only took out 4468. I'm going to have to correct it by $500. This is my thing to correct. It's a permanent issue. All right. And I know I'm going to have to deal with it. And the $25 of service charges, the bank every single month, I know this. The very last thing they do is they take out the money that they're going to charge me for having a bank account with them. This is going to be a difference between the two accounts until I correct it. It's a permanent issue. All right, I've looked at every single item on here. I go over here. I see I had a deposit. I did it on the 30th. It's not in the month of November, right? From November the 1st to November the 30th, I don't see the deposit. Maybe I go online and look at my account quickly and I see on December the 3rd it was made. For whatever reason, I put it in November. It's a timing issue. I'm just waiting for the bank to recognize it. Timing. Same thing too. I have all of these checks to 1228, 1229, 1230, and not to be forgotten, 1218. They're all still outstanding. I'm just waiting for somebody to cash them. It's in some Yahoo's hand, and they're going to have to cash it. Just waiting. All right. So whilst I'm waiting, there's nothing else I can really do. They're all timing issues. Great. I've now looked at every single item that I've isolated and I've given an opinion, permanent or temporary. The permanent items have to be dealt with. They have to be added to my story. I'm going to have to correct my story to match it. All right. So how do you do that? How do you correct your story? I want to think about my business. Here we go, my bank account. And I have to remember that my ledger has a closing balance. The books have a closing balance of 19. That's from October. That's from October. My November balance is 26,983. I want to put it up here. 26,983. That's the closing balance as I see it. I now have all these permanent items, and what I'm going to do with these permanent items, I'm going to write them into my story. How do I write them into my story? You add the sentence. What's the sentence? It's a journal entry, right? We're going right back into chapter 2 of our learnings inside this class, and something's happened. We want to recognize it. First thing is we had rent collections. I know that I'm collecting rent. I know it. I see it at my bank account. It's legit. I just forgot to write the sentence for it. It happens. So now I go and I write the sentence for it. I'm going to turn around, and the key thing is I want to look at it and say, look, my bank account increased 880. I want to reflect it here. How do I increase my bank account? Well, I remember my aller and DRCR. And an asset increases with a debit. Of course it does. So for this first one, I'm going to debit my bank account $880. What's the offset? I'm not given a chart of account for this question. So all I have to do, once I get this is the key part, right? This is a very, very key part. The offset is I just want to select something. So I'm going to say, look, it's rental income, rent revenue, something that's going to get me close. I look at whatever counts come in the drop down box. I see rent revenue. I grab it. The main thing is once I post this 880 pops up here. Once I go and I post this 880 pops up here, which means it's on this list and on this list. Okay, once it's on both lists, I can eliminate. All right. The next one is this non-sufficient fund for 433. Once again, I knew about it. I just forgot to write it into my story. So now I want to go and write it. It was a customer who had paid me. The main thing is I want to recognize that it's a reduction, a withdrawal of my bank account. So I want to reflect that inside of my story. A withdrawal of an asset, a lowering of an asset is with a credit. So I CR bank account 430. I can't write a journal entry where there's only one account and the debits don't equal the credits. I'm not given a chart of accounts, so I just picked the best one on the list. It's a payment from a customer. It's an accounts receivable. They did not pay me the 430. They said they did, but the check never came to me. 433. Sorry, 433. Ah. So I go and I write that in. The main thing is once I go and I post this, the 433 is now in my books, lowering my bank account, and it did exactly what it was supposed to do. I eliminate. Go to my next permanent item. I deal with all my permanent items first. I see I have my electronic transfer fund of insurance. I'm paying for my insurance. I'm paying for my insurance. Great. The main thing is I see it's a withdrawal. It's a lowering of my bank account, so it should be a credit to my bank account. $275. What's the offset? I'm not given enough details. I see on the thing I have prepaid insurance or I have insurance expense. I see whichever one I have and I grab it. Whatever makes sense. It's not going to be too tricky. Once again, I read my sentence. I've used at least 2 accounts. My debits equal my credits. I like it. I go and I post it. As soon as I post it, it magically pops up in my ledger. I look at it. It's now on both lists, my books and my bank. It did exactly what it's supposed to do. I eliminate. I get down to this number A. I do recognize that it's a permanent issue. I made the mistake, so I have to correct it. And what happens is I should have taken out 49.68. I only took out 44. I got to take out another $500 for this thing to equal. Okay. It's a payment to a customer. So I know that I paid the customer more than I thought I did, meaning I lowered my accounts receivable. So once again, it is a credit to my bank account, but of only $500 because it's the difference between the 4468 and the 4968, and a lowering of an accounts payable. Post it. Once I post it, it magically goes up here. And once it goes up there, then these two did exactly what they were supposed to do. 4468 plus 500 is 4968. 4968 did exactly what it's supposed to do. I'm done with it. Okay. I've got 2 more items left on the permanent side. I have this bank collection for 1430. Once again, I made the information a lot simpler. So all I'm going to do is recognize the fact that my bank account would have gone up 1430 because of a payment of a notes payable. Notes receivable, sorry. I go into 5. It's an increase to my bank account, so it's debited 1430. And the offset is my notes receivable. Once it's paid, they no longer owe it to me. It goes down. I go and I post it. Once I go and I post it, it magically pops up here, which means it's in my books and my bank account. Did exactly what it's supposed to do. I eliminate. Okay. There's one other permanent item left, and that's these service charges, the bank charges. I've run out of room here, so I'm just going to pop it in here, number 6. And once again, I recognize that my bank account's going down $25. It's decreased with a credit. And the offset is I look at my list and I see, I don't know, service charges, bank fees, whatever I see that fits it close enough, because I have to have at least a debit and at least 2 accounts, and a debit equals a credit. Bank service fees is what I see, $25 bucks. And once I go and I post it, it magically pops up here inside of my ledger. Remember all this from chapter 2. And it's on both lists. my bank and my books, once it's on both lists, it did exactly what it's supposed to do. I can eliminate. Okay. And now I've eliminated all of my permanent issues and only have several timing issues left. That's exactly the position I want to be in. Now, something else has happened. My bank account has a new balance because I left off at 26,983, but all of these 6 journal entries, 1, 2, 3, 4, 5, 6, right, are now inside of my new balance. So I quickly added up based on my, remembrance of, once again, chapter 2. Can I get away with this? Here we go. Just making myself some more room. So I add up my debit side and I add up my credit side. I've got 26983 plus 880 plus 1430 is 29,293. And my credit side is 433 275 525 1233. My debit side's larger than my credit side, so I take my debits minus my credits, and that gives me a new balance of 28,060. Okay. I know that my books are still different than my bank statement, this legal document. And that's okay because I still have a bunch of timing issues that I'm going to need to deal with. Okay. This is where I go and I start to actually write my bank reconciliation. I look at bank rec for November 2020. So specifically November the 30th. What you do is you give your name of your company that you're working on a bank reconciliation and the time period, November the 30th, 2020. Okay. You always start off with your bank balance as of November the 30th, 2020. This is your bank account, RBC, BMO, whoever gave you your document that you're trying to prove. And it's this amount, the closing amount that you're trying to approve. People always grab the wrong amount. They grab this amount, they grab this amount, they grab all these different things. I'm trying to prove the fact that when the bank statement says at the end of November, I have 29,914, I'm trying to say that's the correct amount. So I'm trying to prove what the bank statement is. And it's 29,914. Is that the correct amount? Let's see how good my memory is today. Yay. Okay, and now all I want to do is look at these timing issues. What this statement says is, look, this 29,914, if time wasn't an issue, if I could keep on adding in all of the transactions that occurred in November, but because of timing issues, difference between cash accounting and accrual accounting, they were not in November's bank balance. If I was allowed to have a statement that would just keep on capturing this, I'd find that these items would change this balance. But I can't do that, so I just say, let's just look at them. Right, I have what's either going to increase or decrease this amount. I look at what's going to increase it, what would have been added, and I see that the only thing that would have increased it is a deposit for 25.98. I did a deposit on November the 30th. That's when I recorded it. It didn't happen inside of my system to something later. Absolutely no problem. I'm just going to go and add it here. Deposit in transit. All in transit means is it's on its way. And that was for 25.98. 25.98. Ooh, my memory's sharp today. Right. And I want to say what would have been less. In this case, all that is going to reduce the amounts are my outstanding checks. I don't have anything else. I just have a whole bunch of outstanding checks. Right. I still have that 1218. I cannot forget this historical item. This historical item will blow me off because it's out of my book balance, but it's not out of my bank balance. I'm still waiting for it. Okay, no problem. I got it. And then I look to my other list and I say, what else? Once it's on this list, it's no longer a part of my problem. Right? Once it's on my list, it's no longer a part of my problem. I now want to look at the other items. I have 1228, 1229, and 1230 for 998, 330, and 2724. So 1228 to 1230. The amounts are 998, 330, and 2724. $998. I knew it too. I was saying it's not the number I said. Great. I add up all of these outstanding checks. 400, 998, 330, 2724. See that they're 4, 4, 5, 2. And then what I say is, look, if these timing issues were allowed to deposit increase, checks decrease the balance, I would have an adjusted bank balance of 29,914 plus 2598 minus 4452, 28,060. Okay. What do I do next? I hope I look at this balance and I compare it to what my actual books say, and I see that now I balance. My amount that's on my books, what's on my balance sheet, is $28,060. The bank statement I have says the value that sits in cash in my bank account is 29,918. There's a variance, obviously, between them of almost $2,000, but I can see that this variance is just timing issues. And if I eliminate the timing issues, the deposit would have made it into November, and these checks would have been cashed in November, and my bank balance would have truthfully been $28,060. They match. I'm happy. I'm good. All right. I've been talking a lot. Let's see if there's anybody still out there. How's everyone feeling? Let me do a poll question to get some interaction, get you people using your computers. How's everyone feeling now that we've gone through the first 3 chapters of the second part of the class? Oh,
Excuse me, I have a question.
go for it.
Uh, I'm just wondering, are we gonna get a break, or we're just gonna end the class earlier? Because I feel like we kind of need the break right now.
Oh no, 100%. I was just going up to a break right now. I need a break too. It's a lot of
Yeah, for
talking,
sure.
but I just wanted
Yeah.
to I would want to see if I wanted to deal with questions that we had now with bank reconciliation rather than take a break and deal with it. So I want
Mm-hmm.
to see everybody seems to be
All right, for
good.
sure.
Yeah. So thank you though, Ahmed. Um, everyone seems to be good. So the perfect segue right now is that I'm gonna go and take the break. Um, we'll take a we'll say that it's 9:45. So I'll start back up again at 10 o'clock. And at 10 o'clock, we will start to go through the final chapters. We may make it to payroll, we may not. We'll see if we time out, but we'll move towards it. Okay. So we'll take the break right now. I'm going to pop right off. Normally I stick around, but I do need a break too to get my voice back together again. So please do what you need to do, but come back to me at 10 o'clock. All right, everyone. Thank you. Hello, everybody. Come back to me. Okay. Okay. So we're going to now move on to, oh, sorry. There we go. We're now going to move on to how do we start to reflect on any sort of risk? We've looked at risk in our inventory and how we manage that. We looked at risk in our bank accounts and how we manage that. Now we're going to look at any risk in our accounts receivable. We talked about this in class. There's a lot of reasons why companies will, excuse me, why companies will allow their customers to leave with a promise to pay. There's a lot of benefits to that. We also know that we have to recognize that risk. Once we acknowledge the risk and we take it on for good business decisions, right? We have to recognize it and we have to do what I call as de-risk the numbers. We want to make our business decisions with as best information as possible. And if we're making our business decisions with numbers that do not account for risks that we've taken on inside of our company, we're going to set ourselves up for failure. Okay, what we're going to do is we're going to look at how do we manage the risk inside of our accounts receivable. The fact that people won't pay us. And it happens for tons of different reasons, but the easiest way to explain it is bad things happen to good companies all the time, right? A company is doing very, very well. It's run by good people, honest biz people. It's a viable business, and then something bad happens to it, and it suddenly becomes not viable for things that sometimes are out of control of the people who are running it. For that reason, they don't pay their bills and they go out of business, and bad things happen to good companies all the time. There's two main ways of us reflecting that risk inside of our financial statements. The first way is focused on the income statement, meaning that it protects the income statement and makes sure that the information that you have inside your income statement is correct. And it's known as the sales percentage method. The other one, which is the aging, focuses on the balance sheet and ensuring that the balance sheet is the one that is the more correct or the most protected. We're going to look at the percentage of sales first. Percentage of sales says, look, every single time we do a sale on credit. So if we have $10 million of sales, but only $400,000 or $10 million, only $4 million of those sales are on credit. That's the only one that has the risk. The $6 million that we get in cash, that's in cash. And there is no risk of us collecting that cash. All right. So you're focused on only the credit sales. Every single time there's a credit sales, you acknowledge that there's a risk of you not collecting that full amount. This risk is tabulated over time, either by looking at your historical information and doing some statistical analysis on it, looking at industry standards, or just using what your gut says in that order. If you have the data to do the analysis, you do the analysis. If you do not have the data, you look at the industry and you use what the industry uses for comparability. And finally, if you have neither the data nor an industry that's known, then you use your gut feel. But really, it should be professional judgment is what's called, but gut feel. Um, really, what you do is you accept whatever we give you at this level. So we turn around and we say, look, for every single sale that we have out there, when we look at it in its totality, meaning that when we look at all of the sales that are done on credit, all the sales that are allowed to occur with a promise to pay that accounts receivable, 5% we don't collect, and that's based on the data. That doesn't mean that every single sale that we have, we only expect to collect 95% of it. It doesn't mean 5% of the customers. It means of that full dollar amount that we allow to leave without the actual cash, we only really collect 95 of it in totality, 95%. Okay. So every single time we make a sale, we're going to take 5% of that sale and we're going to put it into what I call, your little insurance, right? Your insurance bucket. So every single time we do a sale, what we're going to do is we're going to have like a little insurance bucket, and we're going to keep on placing in 5% of sales. Every single time there's a sale, we're going to take 5%, a little tiny piece of that sales, and we're going to put it in our insurance bucket. So when a bad thing does happen to a good company and that value has to be taken out, we take it out of our insurance policy. Okay, because we don't know which sale it is. If we knew which customer was not going to pay us, I'd argue not to sell to them, right? We don't. So we just say, let's take away a little bit from every single sale and put it into our insurance bucket. And then when we do figure out who the one person is that's not going to pay us, or the customer or whomever it is, we can use this insurance policy to help us manage the risk of the individual not paying us. All right. How does that look? Right? Every single time we make a sale. So we have a sale, and let's say we have a sale for $10,000. Woohoo! $10,000 sale ready, right? We're going to turn around and remember when we write the sentence for this $10,000 sale, we credit our revenue. Normally, what we would do is we would debit our accounts receivable and we'd credit our revenue. That'd be the normal statement, right? That's what we were originally taught. But now we want to get into this concept of risk. Now, whenever we talk to the customer, and let's say it's a $10,000 sale to company, um, yeah, 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 right? So whenever we talk to company, yeah, yeah, we want to say to them, you owe us $10,000. We wouldn't break from that. We're never going to give the customer the concept or the expectations that we're not expecting the whole $10,000, right? You never want to give them that. So we're always asking for that. Where we relieve the pressure, remember, this is the income statement approach, is that we reduce the expected revenue, not the expected revenue, we reduce the revenue by the 5%. So now it's only 9,500. All right. And where does that other 5% go? We set up something known as our allowance for doubtful accounts. This is our insurance. Now, our debits still equal our credits. We've used at least two accounts, but what we've done is we've managed the risk differently. Okay, and we've held off an insurance policy. So when I look at my total sales for the period, we look at it here, the total sales for the period. Once again, only the credit sales. The total sales was $300,000, but only $200,000 was on credit. We're only going to accept that. Okay. And we're going to set up our actual individual insurance policy based on that. All right. We're going to look at the individual sales go up here, not this expected bad debt. Do it the way I'm going to show you right now. They're both correct. This is the way I want you to do it. This is the way Pearson expects it. So when we look at it in its totality, all of those sales, it's on the $200,000. So each of these individual ones would equate to the $200,000, right? When we start to think about the credit for our revenue, it's less the 5%. So it would be 190,000. And our allowance would be 10,000. Okay. Now, the importance of this is that it allows us to um, protect our business against bad things happening to good companies. So if the 5% keep on adding up and adding up and adding up. In this case, the 5% are $10,000. Now, if we would have looked into our allowance at the beginning of the period, the opening balance, and the opening balance was $2,000. then as we add in this $10,000, the bucket would continue to grow. The bucket would continue to grow until we take something out. All right, the insurance policy gets bigger and bigger, 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 bigger. Think about it this way, you take 5% of every single paycheck you get and you put it aside just in case. They call it the rainy day fund, right? You put it aside and you put it aside and you put it aside, and if something bad happens that was unexpected, you can then go and use the money that you've put aside to help you manage that unexpected thing that happened, that risk. So if there's an opening balance, you just keep on adding to it. Keep on adding to this insurance policy 5% at a time, filling up your bucket until something occurs. And that's what happened here. We had an opening balance. There was already an opening balance of $2,000. So when we look at it in its totality, it is $12,000 in its totality. Okay. So when we have something that occurs and we want to look at our balance sheet and our income statement, we'll call it before and after. And our income statement, before and after. Right before anything else happened, we had our $200,000 in sales, right? So we have our okay. So here we say we assuming 190. Of course, your AR goes up and down. So we're going to assume that in accounts receivable, there's $190,000, right? And if we look at our allowance, we've calculated it out and it's $12,000. Now notice this is a debit balance and this is a credit balance, right? So when we look at the net of the two, it is really 178,000, correct? 190 minus 12 is 178. And when we look at our revenue side of the company, the revenue just for our credit sales was $190,000. Okay, that's it. Now we go and something bad does happen. We have a customer. Oops. Let's just say customer. Who do we have? We had Yaya, right? Remember Yaya? And the $10,000 that they owed us, they're never going to pay us. This could be customer from way back in time. It could be from anything, but they turn around, they say $10,000 is never going to pay us for whatever reason. Bad things happen to good companies all the time. They're not able to pay us. They're never going to pay us. We know that they're not going to pay us. Once we know that a customer is not going to pay us, or the risk of this customer not paying us becomes very, very high, we have to acknowledge that the future value of this AR, yeah, used to be $10,000, but now we have to acknowledge that it's lost its future value. They're not going to pay us. It's not going to turn anything into the future, so it has no future value. We have to recognize that we have to reduce or eliminate this asset. So we must credit it. Perfect. Well, we can't have a journal entry with just one account and our debits don't equal our credits. Where do we put it to? Well, this is where we use our insurance policy and we put it to the allowance for doubtful accounts. Okay. Now, after this occurs, we note that the AR, that's a balance sheet account. The allowance is a balance sheet account. All right. They're both balance sheet accounts. There's no income statement account inside of this journal entry. If there's no income statement account inside of a journal entry, that means there's no effect to our income statement. There's my before and after. Isn't that funny? Did I have a slide that I deleted? Oh, there it is down here. Sorry. So when we look at that journal entry, it was two balance sheet accounts. That means there's no effect to my income statement. Perfect. The income statement wasn't damaged by the fact that the customer could no longer pay us and we lost its future value. Now, when we look at our balance sheet, we recognize the fact that our total AR, which Yaya is a part of the total, it's one of many different customers we have that owes us money, their $10,000 has disappeared. So the value of our accounts receivable goes down. We can see that. This AR account is a sum of all the individual AR accounts, right? And the Yaya used to be a part of that. $10,000 was here. We've gone and written it off the before and after, and now it's only 190. In addition, though, we also recognize the fact that my allowance for doubtful account used to be $12,000, but we took $10,000 out of it with a debit, so now it's only $2,000. Debit balance, credit balance, 178. So we wrote off a customer that had 10,000, owed us $10,000. And what's the effect to our financial statements? Nothing. The income statement did not change and the balance sheet did not change. Okay. And when we were making decisions and we were talking to our external customers and they said, how much money do we owe you? We always said $190,000. We never broke from $190,000. If somebody owes you money, you tell them you want your $190,000 back. But internally, as we were managing our information, we acknowledged that there was risk inside of this $190,000, and we valued that risk at $12,000. Meaning that when we talked about the monies that we were expecting, that future value we were expecting from our customers, we expected it at $178,000. We based our business decisions or our analysis on our performance at $178,000, not the 190. We used the de-risked number because when something bad happens to a good company, we want the effect to our numbers that we used to make our business decisions to be the same, not affected by the change. No effect to our income statement, no effect to our balance sheet. Okay? For some people, the method makes sense, but it doesn't seem to be very fair. Every single sale, we're going to take off 5% of that sale just because bad things happen to good companies. That's not the reality of the situation. The reality of the situation is that we start to recognize that people aren't going to pay us based on time, right? You go and you lend your friend some money and you say, Francis, can I have some money for lunch? And I say, yes, of course, I'll help you out. Here's $20. Don't worry about it. Pay me back next week. Perfect. The next time I see them, which is 2 days later, they haven't paid me back. I'm not even thinking about it because I specifically told them, pay me back next week. Right? Come next week, they still haven't paid me back. I'm not really upset. They're a good friend. I know they're going to pay me. But 1 week becomes 2 weeks, 2 weeks becomes 3 weeks, 3 weeks becomes a month becomes 2 months. Now, as time goes on, the likelihood of them paying me starts to go down. And I may be saying to them, hey, look, can you pay me? And they're like, yeah, totally forgot. I'll bring it next time. Next time I see them, they still don't pay me. Right? I start to get the feeling as time goes on that they're not going to pay me. And the risk is increasing of them never paying me. Same thing in business. If I turn around to my customers and I give them 30 days to pay me, my expectations is they're not going to pay me before the 30 days. It's just a reality. The money is better in my hands than the person that I owe to. So I'm going to pay them in the very last second. So if I've given somebody 30 days to pay and they haven't paid in 15 days, there's not much risk of them not paying me because I told them not to pay me in 30 days. And then maybe the 30 days becomes 60 days and I'm still like, stuff like this happens. I give them a little nudge and they'll pay me. But then 60 days become 90 days, 90 days become 120. And as I get further and further away from the original promise, the likelihood of payment reduces substantially. And the allowance for aging AR or the balance sheet approach focuses on telling the story that way rather than saying every single sale there's 5% right off the bat. Okay. Now, the buckets may change. I use 30 days as an example. I use 1 week as an example. It's just based on the fact of, what's the reality of how you ask your customers to pay you. If I give them 30 days to pay me, I typically look in 30-day buckets. 1 to 30 has the small amount of risk, 31 to 60 has a little bit more risk, 61 to 90 has more risk, and over 90 days has more and more risk. Eventually, you just lump everyone together. If I gave people 90 days to pay, then I may want to look at 1 to 90, 91 to 120, and so forth. Okay, these buckets don't really matter. It's just a commentary on, I don't want to look in this in weekly increments if I'm giving people 30 days to pay us, because I tell you to pay me in 30 days. I shouldn't be looking at every 7 days if you've paid me or not. All right, so don't worry so much about the buckets themselves. You'll be told the bucket. In addition, you're also going to be told what that estimated risk is for each one of these buckets. Once again, this estimated risk is based on statistical data, industry standards, or your professional judgment. Doesn't really matter where it came from. You're being told that that's the amount of risk that follows through with the individual buckets of time. If we look at an example here, here's a company. They have their 1 to 30 days, $90,000, and there are 31 to 61 days. This could all be populated. It doesn't really matter, these details. We're looking at the buckets, right? And so forth. We have $190,000 inside of our AR, and this is how old each one of those items are. Now, for this item to be in, let's say, this $35,000 to be here, last month, that $35,000 was in this bucket, right? As time moves on, you move up the scale, all right? So these $90,000, if the people don't pay me, next month it'll be in this bucket. And if they still don't pay me the month after that, it'll go to this bucket. It'll keep on moving up this ladder. So there's a little bit of risk in here because for this item to get to here, it had to at one point in time been here, right? So there is a little bit of risk. And then the risk increases. Now, that's a key point. The risk increases. I don't go from 2% and then add on another 10%. I go to 2% and add on another 8% as it moves the threshold from 30 days to 31 days. The risk increases 8%, not grows another 10. All right. Used to be 2% when it was in this bucket. Now it's 10% in this bucket. That's an additional 8%. It goes over here and becomes 25% risk. It's an increase of 15% from 10 to 25 and so forth. Okay. And all I do is I take the individual bucket amounts, multiply it by the rate to find out how much insurance I want to carry for each one of those. All right. In this case, $90,000 by 2% is 118. 118, $1,800, $55,000 at 10%. Notice it's almost half, but the amount of insurance is more than doubled. All right, and so forth. I just multiply the total amount by the expected amount of risk. That will give me the total amount. And I see at the end, when I add them all up, my insurance policy should be worth $25,550. Now, should be worth. This isn't in addition to everything else, because this is the stance of how my $190,000 looks now as far as aging. And of the $190,000, my risk is over $25,000 that I should be covering. So once again, when I go into my balance sheet and I see an opening balance of $2,000, I see an opening balance of $2,000 already inside of my allowance. This is a little bit different than the sales approach, so make sure you understand this. I see the opening balance of $2,000. I say I want an insurance policy worth $25,000. It doesn't mean I add it. It means I want it total to be that. All right. How do I make this statement true? I have to increase this account 23,550. And that'll make that statement true. All right. If the opening balance would have been, allowance, and the opening balance was, let's say, $50,000, and I say that it should be $25,000, that means I got to reduce it $25,000. Okay. So the opening balance dictates the amount that you're going to place in or take out from your allowance account. little bit different than this. Whoa, what happened? A little bit different than the sales approach where I just keep on adding on and adding on and adding. All right, so how do I make this truthful? I need to put on the 23. So I need to recognize it inside of my actual journal entry. So I see that I CR my allowance. 23,550. The offset would be to my bad debt expense. Okay. The offset would be to the bad debt expense. Then when something occurs, so when I look at my balance sheet before and after, right? When I look at the balance sheet before and after, here's the before and after. I go and write the $10,000 customer off. Once again, the $10,000, when I write them off, would lower the overall AR, but would also lower my allowance, giving me still no change to my balance sheet. And once again, the write-off would be a credit to my accounts receivable, a debit to my allowance, both balance sheet accounts. There'd be no effect to my income statement. And it would look like there'd be no effect to my company because I properly have de-risked the numbers prior to understanding who the unfortunate company is that will not be able to pay me. All right, how's everyone doing with the allowance method and the aging and the sales method, the way of protecting my accounts receivable? How's everyone doing? Okay. 60-40 split between all's good and keep going. Wow, we've really flown through this. We got half an hour. We're actually going to get to payroll. This question is a lot harder than the one that's on the exam. What I do pull into it is the concept of, and I believe this was in the, yes, this was 100% in the homework question, so we'll copy it as well, that inside of their growth, they have not only their monthly pay, but also a bonus as well. And we have to acknowledge that this is a part of the gross pay as well. All right. So we're going to go through this question. We're going to quickly say what is gross and what is net. All right. And we're going to set up our journal entries to record our payroll. All right. I always do that. Suddenly noticed that I'm hungry. Anybody else hungry? Did not have breakfast. Came straight into class, and now I am hungry. But we'll finish this question, and then I will go and see if I can find any food. Yeah, yummy. All right, focus, Francis, focus. First step is I want to understand what is my difference between my gross and net pay. The gross pay is what the individual earned. The net pay is what hits their bank account. And there's a difference. Why? Because there's deductibles taken off of every single person's pay. There's mandatory ones and there are voluntary ones. If you are considered an employee of a company, then you have to have these items taken off of your pay. The first thing is that the gross pay is what you earned. For this individual, their gross pay is not only their salary, but also they have a bonus. It's part of what they earn. All right. For this individual, right, I'm going to do this. I set it up monthly. I'm going to do it annually so you can see it go through annually because I want to hit the maximum amounts. Okay. I want to hit the maximum amount so you can see what to do. I'll do it monthly and individually, monthly and annually. So you can see that. So you do not forget. Monthly, the person gets paid $7,500 every single month. You times that by 12, and that's $90,000. Nice amount. The person also got paid their annual bonus, and their annual bonus was they earned their year-end annual bonus is 10%. Okay, it's 10%. So they earned 10% of their actual salary. Now, inside of a normal month, you wouldn't see it there. The last month you would. Okay. So, depending on how the question is, in this case, it would seem like the person we're focusing on the pay of 2018. So, in the individual month by itself, you do not see it. All right. Only on that last month would you see your bonus. Fair? Whoever here has gotten paid a bonus, they dictate at the end of the year the exact amount, and they add it to your pay. All right. So the typical monthly one does not have it. The annual one, the collection of all 12 months, does have it. Great. So your gross pay typically is 7,500, and for the year it's $99,000. Now you start to look at your, call it, net gross pay. All right. Then we let's start to look at your deductibles. Oops. All right. There's three mandatory ones that every single person is evaluated on. The first one is income tax. If if the business believes that you're going to earn more than $11,000 in change, it starts to withhold income taxes and gives that to the Canadian government on your behalf. Why? So at the end of the year, when you have to pay your income taxes, you actually have paid the vast majority of them. Inside of this question, you either are given a percentage or amount. I give you a nice little amount, and it says it's $2,398 per month. And I multiply that by 12. 2,398 multiplied by 12 is 2,877.6. I also see that I'm told there's a one-time charge for the bonus of $4,512. Okay, there's my income tax mandatory. Your CPP is based on a calculation of, I typically give the percentages, but here I just gave you the amount, $408.75, up to a maximum of $3,166.45. Right? So normally it's just $408.75. Now, normally I would just multiply it by 12, but if I times that by 12, it's $4,900, greater than the $3,166.45. I go up to that amount. I don't pay a penny more. Okay. So once I hit the max, I leave it. I stop taking it off. You start to recognize this. My paychecks typically sometime around June, sometime in June, I start to see that I get more cash in my bank account. My net pay goes up. Why? Because these amounts start to zero out because I've already put in the maximum amount. EI works the same way. It's a percentage typically taken off your gross pay. If I say 1.58%, it's times by the gross pay. I don't give you an actual percentage. I just tell you the dollar amount. It's $118.50 up to the maximum of 88945. So once again, 118.5 monthly on a normal month. But I see that over the 12 months, I go over the maximum amount of 88954. So I only put in the maximum amount, 88954. Okay, I stop at the maximum. This individual also has some voluntary. So these three are all mandatory, even if it's zero, because your company believes that you're not going to earn more than $11,000 in change. If you're like, where do these numbers come from? Once again, this is just a review. I'm going over stuff quickly. You can see what you know and you don't know, and you go back to the individual class recordings to get the full details, right? I spent 3 hours talking about this, not 30 minutes. Okay, so you'll understand the graduated income tax scale. But if you even you'll see a zero, it's still looked at, it's still calculated, it just comes out to zero, right? These are mandatory. You're going to see at least a description of each one of these three. Every single Canadian who's a part of a payroll is this, not a contractor, a payroll. Now, there's also some voluntary ones. This individual wants $55 per month put into their RSP, and they also want to give to charity and give $37.50 per month to the United Way. These are deductions that the employee, Patel, has opted into, meaning they have requested them. They could have said no, but they asked for them. So they have RRSP for 55. Over 12 months, that's 660. And they go to the United Way and give to charity at 37.50. Funny number. But I guess it's $450 they wanted to give per year. All right. No maximum amounts for this ones or these ones. Now, when we take away all the deductibles from the total gross pay, the net gross pay, that will give us our net pay. Get rid of this net pay here and just call it total gross pay so there's not a confusion. Right? Gross pay, net pay. And what you do is you take the gross pay less all of the deductions, and this is the final amount that will go into the employee's bank account. $7,500 minus your income tax, minus your CPP, minus your EI, employment insurance, minus the RRSP contribution, and minus the charitable donation. Leaves me with $4,482.25. This is the amount that the employee to take home pay. And the same thing goes over here. We look at all of my deductions. $99,000 is the gross pay, less all of the income tax, less the CPP, which got maxed out, less the EI, which got maxed out, less the RRSP contribution, and less the charitable donation. All right. Once we go and we do this, this is the difference between gross and net pay. You may be asked to journalize this because this is not a part of your story. This is what's happened, but it's not a part of your story. If you're asked to journalize it, excuse me, it's quite simple. You're going to look at the payroll expense, which was, I'm going to do the annual. And then you want to look at all of your deductibles. I think this is right. I have my income tax payable. I have my CPP, CPP payable. I have my EI payable. I have my RRSP payable. I have my United Way An I. Payable. And then, of course, I cannot forget I have the payroll payable. I got to pay my customer, my employee. Okay, I had one too many. And I'd go and I simply put in all of these amounts. Okay, for the income tax, it's the 28776 plus the 4512 or 33,288. This is the 316645. This was the 88954. This was the forget 660 and 450. And then finally, the amount that would hit the bank account of the employee, $60,546.01. And your debits equal your credits. In addition, there's not just only the employees' deductibles, there's also the employer's deductibles. For this individual, they have to pay into the CPP as well. They match the amount taken off of the individuals, deducted from the individual's pay. And they also have EI, which is 1.4 times what the individual paid. The total amount, not just the individual. So they would, if the employee paid the maximum 88945, the 88954 as they did, they would take off that full amount of, but at 1.4 times. In addition, they also have non-mandatory. Those first two are mandatory. They have non-mandatory. They also pay into a dental and drug plan of 38%, okay, and a pension benefit of 7%. Now, whenever you're given a percent, it's always off of gross pay. All right, this one's of their base salary only. Okay, 7% of base salary only. So it's only off of their gross pay, but only specifically the monthly salary. So we would have additional costs to the individual, to the business. Number one, so they have the not only the total cost to the business, is the payroll expense of 7,000. We'll do annual again. I want to do annual again so there's no confusion over when we hit the maximum amounts. 999000. So the base and the bonus. I then have my CPP contribution, which I would match what the individual put in. In totality, they put in $3,166.45. $3,166.45. I look at the EI, but it's at 1.4 times what the employee put in. Once again, the maximum amount that they put in. So it's 889.54 times by 1.4. Where am I? So 1, 2, 4, 5, and 36 cents. In addition, I pay into a dental and drug plan of $38 per month. I'm looking at it annually. Drug plan, 38, but it's annually by 12, 38 times by 12. Each individual, I put $456, an additional expense, and pay into their pension. I have a pension plan of them, 7% of base pay. And their base pay is that $7,500 per month. So 7,500 times by 12 is $90,000 times by 7% is $63,000. So this employee in totality costs me not $99,000, but I also have to pay into a CPP payroll expense, an EI payroll expense, a drug plan, and a pension. Oops. Here we go. So this individual really cost me $110,000. Okay, not the 99, 110, because this is mandatory. I'm charged this by the Canadian government, and I must Canadian Ontario government, and I must pay into the pension plan. I must pay into EI insurance. And I opt into these, but these are expenses as well. And once again, this is just a sum. If I'm asked to do a journal entry on this, I understand that I must recognize this. I would separate out the mandatory and the voluntary ones, because the mandatory ones I put into payroll expense. So it wouldn't just be the wages alone in there, but in addition, there would be the CPP payable, 3166.45, and the EI payable. So I'd pay them in the end, and that was 124556. 124536. Almost. Right? Once I journalize that, it would increase my payroll expense and set up two new payables, short-term payables. And I would also do a journal entry to recognize that I have a drug plan expense, and that is for $456, and I have that payable. And finally, I would go and recognize I have a pension expense of 63 and a pension payable. I have to go and give somebody this money, 63. And now my financial statements match this total. Okay. And that's payroll. Once again, went over that quickly. Somebody are going, oh, you went really fast. Don't forget, this is just a review. And if you find yourself going through any of these particular items, looking at how we did inventory valuation, looking how we got to gross margin and percentage profit, how we got to um, our bank reconciliations, how we got to protecting our AR by de-risking the numbers, or finally how we did payroll. If you get to any sort of segment inside of this review and you're like, wow, that went way too fast, I don't get what Francis was saying, it's not meant to reteach you this stuff. It's meant to refresh you. And if you find yourself having a problem, absolutely no issue at all, go back to the video of when I taught it in totality, when I spent 3 hours on it, not 30 minutes on it. And that will help you get the answer. You can always go back to your homework questions and look at your performance there. All you need to do is go into results in My Accounting Lab, and you're going to be able to review what you did and what the answer was. If you missed the homework, you didn't do it, there is no ability of reviewing your work. So this kind of comes with the caveat you can re-look at your homework if you did it. Going under results in My Accounting Lab and clicking on the particular chapter that you want to review allow you to look at the homework, see what you answered, where you got it right, where you got it wrong, and what the correct answer is. Okay. I hope this was helpful. I know I went fast. It's a lot of material. It was a lot of me just talking to you, but once again, it's just meant as a review. This is the last time I will be presenting to you. The next time you're in this class, which will be next week at 8 a.m., will be to do the final. I'm going to reopen, if I have not already, reopen that test so you can test to make sure that when you're start up the exam and you're going into the Respondus, which locks down your computer and takes a video, it records the entire time you're online. So please don't pick your nose. I'm looking. That your system's set up for it. So you can go and make sure that your system is set up for it. I'll open it up if I have. I'll check today. I was supposed to check last night. I did not, but I'm pretty sure I reopened it. But if not, I will open it again. So you can just test your system and make sure everything's cool. If it worked last time and you didn't do anything new to your computer, it will work. But always test. It's always good to test. My calendar is filling up fast. So if you have a need to sit down and talk to me, I would start making those requests now. Next week is getting full fast. I've got 150 students, and not all in this class, but obviously in different classes. But my time is filling up. Um, Outside of that, I can answer anything by email as well. The more time you give me to answer, the more likelihood you'll get a good answer. And my advice to you is to focus on the second part of the class. If you have limited time to study, to focus on that second part of the class. You know what the big buckets are. I kind of made it obvious here. And I think I'm just now just trying to fill up time. I'm 2 minutes over. So I'm going to stop recording here. So anyone listening just in virtual land, it's been a pleasure. Thank you very much for your time. I've now stopped recording, so the class is now officially over.